This week on The Rocks, we have Archie Hunter from Bloomberg News. Archie covers commodities trading companies and commodities trading for Bloomberg in London. Prior to joining Bloomberg, he spent 8 years reporting on and pricing metals for fast markets. On this episode, we cover Metals Traders 101. Who are they, what do they do, and how is their role changing in the mining industry? Pour a glass or a cup of coffee, and let's dive in. All right, Archie, thanks so much for coming on The Rocks. This morning my time, this evening yours. It's great to have you here.
Thanks for having me on.
I am personally having coffee this morning, or actually a triple espresso, because it's one of those days.
One of
What are you
those.
having today?
So my wife is pregnant and we're getting into a lot of non-alcoholic stuff. So I've got a non-alcoholic cider called Sassy from France. um, yeah, it's really pretty.
Oh, good. Awesome. Well, so I'm excited to have you on today because we're going to chat a little bit about a part of the industry that I think most of our listeners are not super familiar with, which is trading companies or traders, kind of the secret squirrel part of the mining industry. So I wonder if you could just give us like a basic explanation of what is a trader and what role do they play in the mining industry?
Sure. Well, just a little bit, I guess, about me. I'm a commodities reporter covering trading houses for Bloomberg in London, and really that's looking at like all kinds of trades as well. So whether that's companies that mainly look at agriculture or oil and gas, electricity or metals. It kind of covers the whole lot, which is super interesting area at the moment. And look, traders or trading companies can be tiny or absolutely gargantuan. That means you get a lot of different participants in these markets. And for miners, look, I guess trading companies are often counterparts and companies that will buy materials from the miners and end up essentially like taking on the risk, both in terms of price, logistics, counterparty, and getting that material to where it needs to go. The other thing is like traders in general have good access to finance. So they're often the companies that help provide credits or interesting payment terms to mining companies. And I'm sure as your listeners know, getting credit and financing is like a sort of bedrock of mining businesses, right? So that's super important as well.
Yeah, and has that been a relatively recent thing that traders have started to get into the financing side, or has that been going on for a long time?
I mean, I think it's been going on for a long time, but sort of more and more going back a few decades, commodity markets weren't particularly liquid. You had some pretty opaque markets across pretty much everything, and that meant for slightly sort of heftier margins. Like if you're bringing something, if you're taking copper concentrates from Canada to Germany, your buyer in Germany might not have great visibility on even the market price for that day, or where the price could be going. As a trading company, companies had, a network usually around the world or in specific locations where they'd know and have good information flow on what could be about to happen as well.
Mm.
Now it's a little bit more different. So, we have companies like Bloomberg, like Prospector, I guess, that where, there's a lot more visibility on what the prices are, what's happening in the market. So, in order, and a lot more competition, I guess, in terms of, a buyer from China can find out and give a call to a miner in Mexico and they can strike a deal without ever having met. So
Mm.
that means for a trader, getting access to units is really important, and building up a long position is really important. So that's why financing is starting to be a little bit more prevalent from what we're seeing anyway, is mainly in part because that enables a trader to get a decent position in the market that isn't, having to buy it on the spot market and then flip it into the sell side. They can establish sort of what they call sticky long positions through having financial relationships with mining companies that are like more than just the short term.
And from my understanding, this is really beneficial for the mining companies because it's, it is a long-term enduring partnership, right? Because the interests are fairly aligned, and that because they want to actually buy the product, they really do want you to go into production and maintain production, and they want things to run smoothly. So from folks I know who talk about it, it's a real positive thing when you're having those discussions.
Yeah, I mean, look, in some ways it is, in some ways it probably isn't.
Mm.
I think anyone who needs money and gets given it is probably pretty pleased. And and
Great
also,
deal. They gave you money. Yeah.
yeah, but at the same time, look, there's always a reason for doing it, and trading companies usually will get some small side terms or a discount to the price, whatever that might be, basis what they negotiate with a mining company as a result of that pre-financing. So for the mine, maybe they need another 50, $100 million to bring. There's a feasibility study, there's everything. They just need to sort of get going and bring the mine into reality. And you can do all kinds of things to get that money. You can get outside investors, you can issue more equity. But another thing is you can get into a sort of an offtake deal with a trading company who can front you the cash, and in the future they'll be your partner for taking on your material. But look, this has been going on for decades. It's just, I guess, more prevalent now that people have, I guess, the miners and the traders have better access to each other, really.
Yeah, no, I think that makes a lot of sense, that it is that increased level of transparency and the technology that allows you to be more aware. And I wonder, is that do you see an impact of that data availability, or just a greater awareness of all the projects out there on how the traders operate? Has it changed behavior at all?
Ooh. Um, I couldn't tell you if it's changed the behavior, but look, the trading companies will have, they'll know about every single mine in the
Hmm.
world that produces whatever commodity that they're doing. And they'll have, a database of mines that they know about that are coming on stream and what they think is going to be happening in the next 5 to 10 years. New projects are things where everyone wants to be the first to sort of strike a deal, get a relationship going, and hopefully have access to that material when it comes on stream in 10 years time. That's really the thing where if you're a trading house, you can get an advantage by doing that. But look, like I said, it's so when everyone has that, it becomes more and more competitive, and the big miners are also getting into more sophisticated ways of marketing and trading themselves. But also, the barriers to entry for trading companies in some senses are lower because the transparency is there. In some sides, they're also higher, because
Hmm.
what we see is sort of since commodity volatility got really sort of picked up. Some banks have sort of pulled away from the commodities trading sector and lending large sums to them. So, if you're not a big trader and you don't have a big amount of equity, some banks are saying that they don't want to deal with companies, and as a result, uh, they can't leverage the money that they do have into some sort of longer term relationship. So it's sort of, I guess, a mix between an expansion where like more and more people have the ability to know what they need to do in the markets and take positions, but at the same time, financing really is the key to everyone in the industry to sort of being able to make that actually happen. And more, it's the bigger players that are taking more of the pie in that respect.
And just to follow up on that, so why is it that you think or see banks not wanting to finance? I mean, it's certainly something we hear a lot about inside the industry. Is it ESG risk? Is it, what's the?
I think part of it is regulation.
Hmm.
So like the Basel 2 and 3, and I think Basel 4 coming up. is making it just more difficult for banks to have risk with various asset classes and companies. We
Hmm.
also had, at the sort of start of the pandemic, prices went down really fast. That exposed some fraudulent activity in
Hmm.
amongst some trading companies, whether that be metals, oil, or agricultural products. And look, some major banks took big hits on that, you know, and as a result, some of them just said, from a corporate level, right, that's it,
Yeah.
not no more for
Not doing
us.
it again. Yeah.
Yeah, but it is complex. Some banks are sort of starting to get back in there and do more business. Certainly, as prices have gone higher, there's been much more demand for that. But yeah, equally, it's like anything in finance. People look at margins and people look at risk, and if it isn't right for them, then they walk away, and that's what we've seen a little bit. The flip side is that this commodities are still quite an attractive class for lending for a lot of people.
Mhm.
So there's some banks that are stepping in to sort of pick up that business, and also some private finance players who specialize in lending to commodity traders and understanding those risks. They say better than others, and charging a bit more money as well. So yeah.
And when you, it might help to kind of clarify, like when you talk about the risks that a trading company takes on, what are some of those risks that folks may not think about, or kind of what does that look like?
Sure. I mean, that's a really great question, and the industry sort of likes to talk about it as they warehouse the risk. So trading
Mhm.
companies warehouse the risk. They when the mining company, if we're using that example, sells them the product, they're giving the mining company good payment terms. They're giving their buyer usually good payment terms, and they're taking usually bank finance, leveraging that in the market to buy, sort of cargoes worth tens or hundreds of millions of dollars, ship them around the world, and make sure, sometimes blend them into,
Mhm.
if you have, some mining companies will have output that's high in certain impurities that will need to be sort of blended away or combined with other grades that make it all right to import into countries like China. Then they're dealing with counterparty risks, where some companies might have not such good credit ratings and find it difficult to pay for things on time.
Mhm.
And as we've seen throughout the whole pandemic, uh, simply shipping something, even if it's
Right.
in container and it's like something from a furniture warehouser from one place to the other, that can be super difficult in and of itself and very
Mhm.
expensive. Um, yeah, so those are some of them. I mean, the other is just simple price risk, and like most
Mm.
companies are fully hedged, but even then, the process of hedging requires companies and traders to put down large sums of money with a broker as what they call initial margin, and then if the price moves far away from where their hedge is, they get a margin call, they have to post additional margin, more cash, and sort of as the prices of commodities have gone up, as they have done quite substantially over the past few years, those additional costs, the margin gets bigger for them to place trades and maintain trades as well. And the likelihood of a bank, or well, an exchange or a broker saying, okay, well, the prices move too sharply,
Mhm.
we're going to have to cancel your trades, also increases. So like we're talking about, these are sort of moving hundreds of millions of dollars of cargoes around the world all the time. That's quite a significant challenge in itself.
Yeah, no, absolutely. And I wonder, could you maybe explain for folks who aren't familiar, what does it mean to hedge in this context? Like, what would a trader be doing to hedge on their price stuff?
Well, most trading companies in the metal space, if they're base metals, will use the London Metal Exchange to do that, and they will utilize a broker or a bank to place hedges on their behalf.
Mhm.
People know about the London Metal Exchange as a place where, there's the old school London open outcry trading ring, the sort of big bright red leather seats, and a load of mostly blokes in suits
Running around screaming,
shouting at each
yeah.
other and making funny hand signals. Um, it's actually a really, really cool place. If you do get the chance
Yeah,
to go for LME week or another time, I highly recommend. I used to do sort of market reports on the sort of sides of the LME ring, and it's an amazing atmosphere. And look, that's really sort of a sort of epicenter of liquidity. You've got huge
mhm,
amounts of each broker will have tons of clients that need trades done at a certain level, and they're sort of pooling that liquidity into one moment where everyone's saying, okay, where do we think the price should be? People will buy
yeah.
up and down, and they'll get a settlement. So that's one thing, but a lot of it is electronic now as well.
Well, I just find it really funny. I love the fact that there still is that activity, right? Because you would almost assume in this day and age that it would be 100% electronic. And like, why do you even need that kind of crazy situation? I just think it's really cool that it still happens that way, even if it's a smaller percentage.
Yeah, well, I mean, it's a sort of existential question for the London Metal Exchange, and has been for some time. But look, I guess the brokers themselves who do that business argued that their clients like having that option, especially if they're
Mhm,
physical market players. And what we see
mhm,
is the LME and the Chicago Mercantile Exchange as well, trying to sort of get more activity coming from financial players and investment
mhm.
funds and hedge funds. But the physical market, I think, probably does see good value in that way of doing trading, and has done for um, over 100 years. So
Yeah.
yeah, I guess it's worked well enough so far. But yeah, no, changes are happening, and it's sort of really interesting to see that. But for that relationship between a mining company and a trading company, often the trader will sort of have, when they're buying something from the miner, the miner will want a certain price. They'll want
Mhm,
to say, okay, well, either we do it at the monthly average, or we want the high point of whatever the month is, whatever was achieved in the month of August or September this year for that cargo. And,
mhm.
for some traders, it's going to be their job to sort of make that happen. They
Yep.
obviously have to stay hedged, but they have to try and give their their mining partner that option as well. So these relationships run quite deep, and obviously, with the big swings in prices, that can mean a lot for a mining company, whether they're super profitable or especially if they're not super profitable. Getting the best price that they can is really quite crucial.
And then for those who may not know, like that's who the trading company is buying from. Who do they sell to? Like who is the trading company's customer?
Well, sometimes it's other trading companies, but
Just adds to the clarity of the
yeah,
situation, right?
but usually it's somebody who's gonna take the next step with
Mm,
that product. So a smelter of various sorts, so precious metals or base metal smelter, and sometimes those are combined. So copper smelters, because copper and gold often come together geologically. They'll be smelting both of those and trying to extract sort of all of the elements that they can. That's where smelters make their money, is ultimately not paying for the small minerals that they get in the main product concentrates, and extracting them fully and selling them on. So those companies, and they're sort of based all around the world, really. Some traders have smelting operations as well, just like big mining companies. But yeah, you'll have smelters usually in places where demand is really high
mhm.
for commodities, but really sort of all over the world.
Yeah, no, it's and I would imagine that a lot of this is changing a little bit and that there are new metals that before were not as in demand, right? I mean, in particular in the battery metal space.
No, well, things like cobalt, which usually smelting companies hated because it
Mhm.
meant that they had to extract it, and it did all kinds of awful things to their lovely smelting plants. Now it's a bit more popular if they've adapted those plants to be able to extract it and then sell it. But yeah, I mean, I guess the other thing with that is that this material, usually sort of metals or fertilizers or whatever's being mined out of the ground, is perishable. It's not
Mm.
yet made into a product that's really made to stand against the elements, and it can change. And smelting companies are enormous. And again, it's something that if you get the chance to go, is very cool to see. But they're putting these this concentrate, this sort of like it's like sand basically, or
Mhm.
earth. It's sort of highly mineralized earth when it's gone through a concentration process. And these are really, really delicate technical operations done at like very, very high degree temperatures. So if something is wrong with that mineralization, it's someone's going to hold the bag basically. And by the time it gets to the customer, that someone's probably going to be the trading company.
Yeah, and I think that brings to mind 2 points that a lot of times folks aren't aware of. Number one, a mine doesn't process something all the way to where a customer would buy it, right? Like a copper mine doesn't take rock out of the ground and typically go through all the many, many steps it takes to make like copper wire,
Mm,
right? And even gold mines, I think a lot of folks don't realize like a gold mine doesn't typically take that rock all the way through like a shiny gold bar that they then sell, right? So there are all these steps that are in between that aren't as kind of well understood outside of the industry of processing and then mixing and blending and stuff. And I always kind of tell people it's kind of like the difference between buying flour and buying bread,
mm,
right? Like there's a lot of other stuff that goes into bread besides flour that has to be mixed and baked and all this different stuff to get you a product that you buy at the store.
right.
And all of that requires financing and risk and adjustment as new products are needed. You have to invest in changing each of those steps.
Yeah, and like to use that analogy, ultimately, if banks aren't willing to finance bakeries, then the price of bread is going to go up, and it's going to be more
Mhm.
difficult for the people who sell them flour to get a good price, or to get a good market for it. So yeah, it is really interesting, and there's tons happening all the time with how these markets and sort of sub markets work that make it really cool thing to cover.
Very cool. Well, I hope more folks start to pay attention after they've heard this. They'll dig in and follow you and see what you're writing about every week. Archie, thank you so much for joining us, and look forward to following what you write about and what you guys are talking about. And thanks for joining us today on the rocks with your
Sassy
sassy
Friday.
cider and my espresso.
Thanks a lot, Emily, and yeah, speak soon.